Adjustments to credit spreads and iron condors. Should you be making them? In this video, you're going to find out. Hey everyone, this is Scott here again with a new video to help you learn how to trade, invest, and master your finances so you can apply that knowledge in the real world and multiply your money. And in today's video, I'll be showing you some analysis along with my opinion to show you that adjusting credit spreads and iron condors is actually not worth your time. And if that sounds interesting to you, then please do me a favor and hit the like button on this video and subscribe to my channel so you don't miss out on any of my future content. Now, very quickly before we get started here, I just want to announce that you can also find me on SKILLSHARE, where you can take my very in-depth classes on options trading and stock market investing. And I provided some links to some of the introductory courses of mine in the description of this video below. So be sure to check them out. And when you sign up for SKILLSHARE using any of those links, you'll get a 2-week free trial. And so with that being said, let's jump on over to ThinkOrSwim now and we'll get things started. Alright, welcome to ThinkOrSwim here, and in today's video we'll be looking at two different stock charts. The first of which is going to be Alibaba, and that's what I have pulled up right here. And this company, in case you are not aware, is basically like the Amazon but based in China. And so the reason why we're going to look at this chart first is because if I go to the trade tab here and go into the April expiration cycle, I currently have on a put credit spread on this particular stock. So as you can see down here, I am short the 230 strike put option and long the 225 strike put option. So this is a $5 wide put credit spread. And unfortunately, with Alibaba currently trading at 224 bucks per share, both of my options are in the money right now. So unless this stock can stage a nice rally in the next 12 days, I'm looking at a max loss situation here. And just for some context here, I initially sold this put credit spread for $168 in credit, which means if you take 500 and subtract 168, that means my max loss on this credit spread here is $332. So that's the amount of money I'd be looking to lose here unless Alibaba can get off its butt and start climbing higher by April 16th. So one thing that I've considered, and I'm sure many of you have considered as well, if you are also selling credit spreads on various stocks, is how can I adjust this kind of position? How can I take in more credit to reduce my potential maximum loss? And so the answer, the easiest way to adjust a put credit spread that is taking on losses is to sell a call credit spread on the other side of the stock. And this would basically turn my position into an iron condor. And so let's say, for example, I wanted to sell a $5 wide call credit spread here, and it's important to keep the width of the spread the same as the initial position because this will keep your overall risk on the trade unchanged. A $5 wide put credit spread plus a $5 wide call credit spread is not going to increase my initial maximum loss. It can only decrease it. So what if I wanted to sell the 240 strike call option and then also buy the 245 strike call option? So let me go ahead and set up the order so you can see how this looks. So I'll right click on the 240 strike call and go to sell and then go to vertical. And let me scroll down just a little bit here. And so now you can see the order down here. We're going to sell one contract of the 240 strike call option and then also buy one contract of the 245 strike call option. So same $5 wide on the call side now. And for selling this credit spread, I would take in an additional $53 of credit. So if my initial credit was 168 bucks from selling this put credit spread in the first place, this additional 53 brings my total credit to $221. But is doing this actually worth it? In my opinion, I would say no, it's not. Hence the reason why I have not actually done this. I have not actually made any adjustments to this position here. And the reason why, if I pull up the calculator here, if my initial maximum loss on this trade, on this put credit spread was 332 bucks, if I now reduce that maximum loss by only $53, 53 divided by 332 is only about 16%. So I'm only marginally reducing my maximum loss, and in the process I am greatly reducing the range in which I can actually profit on this trade still. If I were to go ahead and sell this call credit spread here, then Alibaba stock must end up above 230 and below 240 by the expiration date in order for me to make the maximum profit on the trade. And then it can also go a bit beyond that range, about $2 or so, and I'll just break even. And that's a very, very narrow range for a $225 stock, right? This stock can move 10 bucks in one day or even more in one day. And so for me, collecting only 53 bucks and reducing my maximum loss by only about 16% is just not worth the possibility of Alibaba starting to rally again and then blowing through my call credit spread here and still giving me a max loss scenario Of course, the max loss would be a bit less than initially, but if you also come back to the charts here so you can see this visually, right, 230 is right here, this horizontal line, and 240 is just right there. So this tiny little range is where Alibaba needs to be in the next 12 days for me to actually profit on the trade if I were to go ahead and sell that call credit spread. And the chance that Alibaba does actually end up between 230 and 240 is very, very small and just not worth the extra 50 bucks or so that I would be taking in as my adjustment. So that's why I'm going to leave this trade alone. And if Alibaba does start to climb higher again, then great. It can absolutely skyrocket for all I care. I just need it above 230 by the expiration date. And then on the flip side, if that just does not happen, if the stock keeps moving lower, then so be it. I have defined risk on this trade. I knew how much money I was risking when I put on the trade, and I was comfortable with that amount. And that should be your mindset as well when you are also using defined risk trades. If you're not comfortable with potentially losing that maximum amount of money, then you need to narrow the spread and go a bit smaller. And I do also know I'm only showing you one scenario here with Alibaba, but from my experience, adjusting any credit spread, generally speaking, is just not worth it in my opinion. And that's because with these kinds of strategies, you're going to have to sell another spread that's very close to the initial spread that you've already sold in the first place. And on top of that, the amount of credit you're going to receive for making that adjustment is typically not going to be that great. So again, in my opinion, and based on my experience as well, when it comes to credit spreads, it's best to keep your risk in check at the very beginning by keeping your max loss in a comfortable range from the start, and then to just leave the trade alone all the way until the expiration date, or until your spread hits your profit target. And so now what about iron condors? So let's come over to the IWM chart now, and that's because I currently have an iron condor position on this ETF. And in case you aren't aware, IWM is just an ETF, like I mentioned, that tracks the Russell 2000 index. And so now when it comes to adjusting iron condors, it's actually even harder and less worth it than credit spreads. So let's come into the May expiration cycle here. This is the cycle I've chosen for my iron condor. And so on the put side, you can see it here. I am short the 186 put option and long the 181 strike put option. And if I scroll down here, you'll see my call strikes. So I am short the 230 strike call option and also long the 235 strike call option. Now so far, this iron condor is still in pretty decent shape, with the price of IWM just under 224 bucks per share. As of right now, none of my options are currently in the money. But you can still notice that IWM is getting a bit close to my call side here. Now if you are going to adjust an iron condor or a credit spread, I would not even consider doing so unless the stock has reached your long strike, which in that case by the expiration day, you would have a max loss situation on your hands. And the whole point of adjusting an iron condor or a credit spread is simply to reduce your max loss. So again, there's no need to even do that to make an adjustment if you don't even have a max loss situation on your hands at the moment. But of course, for the sake of example here, let's say I did want to go ahead and make an adjustment on this iron condor because I am now a bit worried about the price of IWM blowing through my call strikes here. So in a very similar fashion to a credit spread is you simply take the spread you've sold on the other side of the stock, the side that is not being tested, and you just move up the strikes. And in doing so, you'll take in more credit. And so what that means is I'm going to first have to buy back my put credit spread here, which is definitely not going to be free, and then also sell a new credit spread with strikes that are much closer to where IWM is actually trading. And so because I have to actually buy back this spread, this is why adjusting iron condors is actually a worse idea, why it's less advantageous than adjusting a credit spread, right? Because with a credit spread, I don't have to buy back anything. I just sell a new spread and that's it. There's no money I have to pay to make that adjustment. So let's go ahead and try to do this here. I'm first going to buy back this put credit spread. So I go to buy and then vertical. So you can see down here, going to buy one contract, 186 strike put option. So I'm going to buy this contract back, and then I'm going to sell one contract of the 181 strike put option right here. So this is how I can close my put credit spread as part of my iron condor, and it's going to cost me $25 in debit. And now if I scroll down here a bit, for my adjustment, maybe I want to sell the 210 strike put option and then buy the 205 strike put option. So let's go ahead and do that. I'm going to go to sell and then vertical. So as you can see, sell one contract, 210 strike put option, and then also buy one contract, and it's going to be the 205 strike put option. And so for selling this put credit spread with strikes that are much closer to the current price of IWM, I will take in $92 in credit. So combining everything now, if I have to pay $25 to close my initial put credit spread, and then I take in an additional $92 for selling this new one, that means the net credit that I'm taking in is $67, right? 92 minus 25 is 67. And also, just for context here, I sold this initial Iron Condor on IWM for $160 in total credit, which means my max loss in the worst case scenario is $340. So now if I'm taking in an additional $67 and my max loss initially is $340, I am now reducing my max loss by just under 20%. That's not bad. A 20% reduction in the worst case scenario is certainly decent, but just like with the credit spread I sold on Alibaba, I am now really handicapping myself by creating a very narrow profit range for IWM. So in this case, by May 21st, in 47 days, I need IWM above 210 and below 230 for me to walk away with a pretty decent profit, with my max profit essentially. And so of course, just like with the Alibaba put credit spread, if by the expiration date, one of my short strikes is just a bit in the money, I can still walk away with a small profit or just breaking even. But once again, coming back to the charts now, 230 is right there, and 210 is right there. So once again, as I mentioned, I have a very small range, a very small window to make my max profit on this trade. Whereas with my initial Iron Condor, as long as IWM is below 230 and above 186 all the way down here, then I would make my max profit on my initial Iron Condor. And obviously this range is much, much bigger than just this range right here. And for me personally, taking in only an additional $67 or reducing my max loss by only 20% is just not worth reducing my profit range down to this tiny little spread right here. It's just not worth it. So just like with the put credit spread in Alibaba, I have defined risk here, and I was very okay with $340 being my max loss. And so that means I'm just going to leave this trade alone. I'm going to hold it all the way until the expiration date. Or of course, if I hit my profit target sometime between now and the expiration date, I'll take it off. But even if IWM keeps going higher here and blows through my long call strike, I'm still not going to do anything. And neither should you. Just keep your risk in check at the very beginning and let the trade play out as long as possible. And I can tell you from my experience, the majority of the time when my Iron Condors or my credit spreads do get tested, even if the stock blows through my long strike, the majority of the time the stock does actually come back around. Meaning by the expiration date or sometime before that, the stock moved back in my favor and I was able to close the spread for a nice profit. So sometimes all you have to do with these Iron Condors or credit spreads is just apply a little bit of patience. And so that concludes this video. I hope you enjoyed it, and please let me know your thoughts or if you've got questions in the comment section below. And don't forget, if you want to take some in-depth classes on options trading and stock market investing, then check out my SKILLSHARE courses, links in the description of this video. And finally, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel, and make sure those notifications are turned on. I'll be dropping new videos every Monday, Wednesday, and Friday, and you don't want to miss out. So thanks again for watching, and I'll see you next time.